and welcome to today's episode of the Capitalized Life and Retirement Show. I'm your host, Matthew Johnson, president and owner of Johnson Wealth and Income Management, a retirement income source located in Clear Lake and Humboldt, Iowa, serving clients in northern Iowa and southern Minnesota. Well, how are you today? I hope you're doing well, taking a little bit of time for yourself. Can you believe it? It is nearly the close of 2025. It's absolutely becoming clearer and clearer to me that clients are right when they say the older you get, well, the faster time seems to fly. It doesn't feel like it should be the end of 2025, but here it is. It's almost Christmas time. And that kind of leads me to thinking about end of year priorities. What are the things that we need to be focused on as we wrap up 2025 for our money, for our investments, for our future preparation for retirement success? If this is something you've been thinking about, if you've been maybe wondering, what are the things that I should be focused on? Well, you've come to the right place. If this is the first time for you, maybe first time watching the podcast or listening to the radio show, I just want to say a warm welcome. If you're new to this program and you've been looking for something that's practical, that's down to earth, something to maybe educate you and challenge you, well, the Capitalized Life and Retirement Show may be just the thing for you. And I encourage you, don't stop with just the podcast or the radio show. Go to YouTube, look up the Capitalized Life channel, where you can watch all sorts of various different educational tidbits on certain financial topics. And go to our website, johnsonwim.com, as in wealthincomemanagement.com. And there you'll find white papers. You'll be able to look up various different topics that are financially relevant to help further your education and your knowledge about those things, as well as being able to listen to past radio shows and even watch some podcasts. If you're the hands-on type, if you're the person that loves reading, I also encourage you, get a copy of my book, The Capitalized Retirement. This is something that's down to earth. It's something that's a very simple read. You probably get through it in 2 to 3 hours. And it's something that you can refer back to. Give it to someone, a loved one, a friend, someone that you think really could use a little bit of help in getting better prepared for retirement. Because at the end of the day, folks, we're all in this together. Every single one of us are rowing in the same direction. We've worked really hard to save what we have saved. And we want to make certain not only do we get to keep what we've saved, but we are able to live the retirement, the life that we want in retirement. And to me, retirement success is having more income than what you need in retirement. So let's get into it. Now, these are not in any particular order, but one of the things that we know about financial things, whether it's the fact that we're contributing or we're taking and doing certain things like conversions, is that there always seems to be deadlines. And when it comes to contributing money for a Roth IRA or a traditional IRA, well, we've got some leniency there. We can always wait until April 15th of the following year to make contributions into those types of accounts and have it count for the previous tax year. So that's cool. That's great. But you know what? That really isn't a very urgent deadline. We've got plenty of time between now and tax filing time. So what we need to be thinking about are the two bigger deadlines. The first deadline is required minimum distributions, or otherwise known as RMDs. Now, we got to remember what an RMD is. If it's unfamiliar to you, a required minimum distribution is something that does not apply to everyone. It only applies to those of us that are 73 and older. And if you've got money in a 401k, you've got money in a 403b, a traditional IRA, or any number of other pre-tax qualified accounts, and you're retired, you're no longer working for that employer, you may be in a position where you have to take a distribution. Now, this distribution, mind you, is not something that is suggested. It is not something that is, well, if you feel like doing it. No, this is a required distribution. This is something that the IRS is forcing you to do. And the reason that the government forces us to do it is because, think about it, we put money into our 401ks and our traditional IRAs all of these years, and we've never paid a dime in tax on any of that money. We've never even paid taxes on the gains of that money over the course of the decades of accumulating and saving and compounding that money. And so the nightmare of the IRS, let's face it, is us dying without paying taxes. And so by the end of the year, the government wants to make certain if you're 73 or older, you've retired from your employer, you've got that account, that you take out a mandatory distribution. Why? So that they can tax you on it. Now, here's the thing. We understand that we have to take this distribution, but what if we don't? What if we don't feel like doing it? What if potentially we get it wrong? We don't take out the right amount at the right time? This could be problematic for us. Now, granted, the government has taken and created a little bit of leniency. It used to be a 50% penalty, 50, you heard that right, a 50% penalty if you're not taking the required minimum distribution the way that you should and the amount that you should. And they've scaled that back to 25%. But let's face it, I don't want to give a single dime to the IRS any more than what is rightfully theirs. So in this particular case, we need to make certain that if we are 73, if we do have pre-tax qualified money, we get with the custodian, whoever we have that money with, whether it's an insurance company, whether it's a bank and an IRA CD, whether it's with a custodian like, say, Fidelity or Vanguard. And we get with that custodian and we ask them explicitly, what is the exact dollar amount that I need to take from this account to be in compliance? Because again, if we don't do it in the right way, in the right amount, at the right time, getting it done by the end of the year, well, we're going to be facing a 25% penalty. And that 25% penalty, mind you, is on top of already the tax that they're going to tax us on. So if we do a little bit of math, that could be a very, very big chunk of money that is going to the IRS. So what's the point? What's the takeaway? The takeaway is be diligent. Figure out what kind of money you have, where it's at. And if you're of the age in which you've got to take a required minimum distribution, don't wait to the last minute. Get that done as quickly as possible. Get that check marked off your list so you don't have to worry about paying that penalty. Now, that kind of brings us to the other deadline that is really just as urgent, and that is Roth conversions. Now, if we have money in pre-tax accounts, we know that every red dime of that money is taxable. And if you're nervous, if you're concerned, or if you are of the mind that down the road we're going to find ourselves in a higher income tax bracket, and well, let's face it, with the amount of debt that our country has, that's very, very possible. You may be wanting to actually pursue a Roth conversion. That's where you're taking money from the IRA bucket and you're simply putting it into the Roth bucket. That's called a conversion. Now, that's a taxable event, but here's the thing. You have to decide how much you're going to convert. And not only that, but you have to be prepared to pay the tax, and you have to get it done before the end of the year. Why is this? Well, it's not like a contribution where the government is giving you until the middle of April to get that contribution made. You can't do that with a conversion. You got to get that converted dollar amount moved from the IRA bucket into that Roth bucket, and you got to get it done before December 31st. But not only do you have that deadline, you also are contending with the deadline of the custodian that money is with. So if you're dealing with the bank, you're dealing with an insurance company, you're dealing with a custodian, a brokerage outfit, something of that nature, remember that they may have their own specific deadlines in, well, transacting and getting that service work done for you. So as my mother would say, don't dawdle. Get it done and get it done right away. Check mark it off your list. Now, there's so many considerations, and we've talked so often about Roth conversions, but I think it's a good reminder that when you do a Roth conversion, remember you can do it a couple of different ways. You can either go ahead and take cash and just move cash from one account and put it into the Roth account, or you can do what's called journaling. And you know what? Journaling has very specific benefits. You see, journaling is simply just taking actual positions that you already own. Maybe it's shares of a stock. Maybe it's individual bonds that you have. It could be shares of a mutual fund or an ETF or an index fund. And what you're doing is you're simply putting a new address on a certain number of shares. You're just simply taking this number of shares from this bucket and putting it into that bucket. But ideally, we want to be thinking about the fact that when we have anything in a Roth IRA, the reason that the Roth is so beautiful is that as those assets in that Roth account grow, as they appreciate, well, that appreciation is going to be totally tax-free. That's pretty awesome when you think about it. And so here's the thing. What we want to do is we want to specifically look for positions that we own, positions that we want to continue to own, but positions that are down. And by taking and moving those positions while they are down, well, guess what? We get to move more shares. And when those shares recover, when they appreciate or come back to where they were, well, guess what? That recovery is now tax-free growth to you. Now, granted, there's guidelines like not touching any of the gains for 5 years on the gains that you have in that Roth IRA. Every time you convert dollars, let's say you take $10,000 from the IRA, you move that into the Roth, and let's say that $10,000 becomes $12,000. Well, you can touch the $10,000 anytime you want. You could touch that the day after you put that into the Roth account because you've already paid taxes on it. But you don't want to touch the gains. You don't want to touch that $2,000 of appreciation for 5 years. But guess what? Here's a little known trick. If you do those Roth conversions towards the end of the year, the IRS doesn't know the difference between you doing the Roth conversion January 1st versus doing it December 31st. So quite honestly, even if you do the Roth conversion at the tail end of the year, the government's going to really allow you to have access to those gains, not in 5 years, but in 4. So it's kind of a clever little loophole that exists within the law and how the law is written, but it's something that you can have for peace of mind so you can get to those gains if you need to just a little bit sooner, 20% sooner. Now, we've talked about required minimum distributions, big stiff penalties if we don't do them on time. We've talked about Roth conversions. We got to get it done before the end of the year, and we've got to abide by the custodian's deadlines. We've got so much more to cover in covering your assets, things that we need to keep in mind before the end of the year. So I encourage you, sit tight. We'll be right back. We'll discover a few more things that we need to be cognizant of as we go into 2026. Sit tight. We'll be right back. And welcome back to the Capitalized Life and Retirement Show. I'm your host, Matthew Johnson, president and owner of Johnson Wealth and Income Management, a retirement income source located in Clear Lake and Humboldt, Iowa, serving clients in northern Iowa and southern Minnesota. Well, how are you? I hope you're doing well today. And if you're just joining us, welcome to today's program. Today we're discussing kind of end of year considerations. As every year ends, we need to think about, is there things we need to be doing to take full advantage of the time that we have left in the year? It also is a time of reflection. Are there things that you would be doing different in the next year than you did this year? Well, we've already discussed that there are some really hard and fast guidelines and deadlines that exist for every single person, whether they're trying to do required minimum distributions for themselves to stay compliant with the RMD laws that say, hey, by the end of the year, you've got to have your minimum distributions distributed to yourself. Or we discuss the Roth conversions, things that can very much help us have potentially less taxable consequence down the road when we're retired. Maybe experience a little bit of pain now to hopefully avoid a lot of pain later. But now we want to turn our attention to a couple of other things. The first one is going to be the biggest, and it's going to be the most important. Let me share this story with you. Many years ago, one of my very best friends, Dave, shared a story with me. When he was quite young, he lost his father to a construction accident. And so his mother raised him. He was an only child. And as he was growing into adolescence, he developed a fondness for a pediatrician that his mother would take him to. Well, after a while, one day he goes in to have his physical with the pediatrician. The pediatrician pulls him aside and says, "Listen, Dave, I don't say this to offend you, but, when my patients start growing beards, they're a little too old for me. I need you to find a different doctor." Now, initially, he was kind of devastated because he really had a fondness for this gentleman. He really looked up to him. But what he was trying to tell Dave is, listen, you've outgrown me. My area of expertise as a pediatrician is for the young, and you're now old enough that you're growing your own beard. You need to move on. Well, you got to think about how that applies to our own money, how we're investing. You see, as we age, we get older, we get closer to retirement, things are not going to remain the same. As I've suggested to you so very often in times past, the math works so differently when you get to the distribution stage of your life, when you get to retirement. And when you're young and you still have the security of the paycheck, taking and putting your money into things that have risk to get growth, well, that makes sense. It makes sense, and in fact, that's what you should be doing. But as you get closer and closer to retirement, say you're within 5 years, you may not want the same level of risk, the same level of potential loss on all of that money. And besides, we need to remember that, when you had $100,000 and you lost 10%, losing 10 grand hurt. It really did. But you could live with it. But think about it now. Today you've got $1 million and you lose 10,000, or 10% rather. It's not 10,000. It's 100,000. You see, the numbers get bigger. They get more impactful. And the reality is that the closer to retirement we are, the less time we have to recover. We have to think about the sequence of returns. We have to think about when I pull the trigger in retirement, am I going to have a retirement that starts out with a booming market that's going up, and then all of a sudden it hits its azimuth and it starts going down? Or am I going to be retiring in a market that has gone down, and in retirement now it's going up? You see, those are two very different outcomes. And we have to be thinking about, are we prepared for that? So I'm going to ask you to consider just one thing. Is it potentially time to take a new focus with your money? And when we think about it, there's really two directions that we can focus our time and our attention and our money on. The first is no doubt going to be growth. And growth has its merits. Everyone loves growth. And guess what? This market really, since after Liberation Day, it's done really, really well. And it's actually done scarily well. In fact, it gives a lot of people the thinking, the thought, the idea, well, maybe it's getting long in the tooth. It's getting ready for a pullback. It's getting ready for a correction. That may be the case. I don't know. I'm not a fortune teller. I can't read into the future. But I'm guessing that if interest rates decline, that's probably going to keep the market fairly stable, at least for a time. But then what's going to ultimately happen is what always ultimately happens. At some point, the stock market is going to experience a pullback. And with the amount of money that you've worked hard to save, the number of hours and years and decades that you've spent saving what you have saved, I'm going to challenge you to answer this question. Are you really willing to accept the cost? If the answer is no, then maybe going into 2026, it is time for a new focus. It is time for a new direction for your money. Now, does that mean that you have to just give up owning common stock? The answer is absolutely not. In fact, that would be silly. Does it mean that you have to give up growth? And the answer is no. That would be silly. We just maybe want to get our returns from that of a different source. You see, as an investor, there's two kinds of returns. There's known returns and there's unknown returns. And the unknown returns, well, when you got the security of a paycheck, trust me, that's okay. That's the game that we all play as investors, as savers for retirement. But once we get closer to retirement, once we get into retirement, now all of a sudden we realize if we lose too much, we could be up the creek. And so this is where we begin to change our focus. We begin to now take a different sense of direction with our money. We're very purposefully, we're investing for those known returns. We want the consistent 5, the 6, the 7 coming from our principal. Because quite honestly, we don't want to run out of principal. In fact, we want our principal to always be there for us if we need it. But what if, just humor me for a moment, just what if all of your principal could be turned into an income producing machine, that every single month your principal was spinning out income checks that you could cash with reckless abandon, income checks that you could cash knowing that the next month it's going to show up the same way as it did this month. How would you feel then? Would you have confidence going into retirement? And so as we close 2025, I want you to think about your business model, how you're investing your money. Is it time to begin to explore potentially a new direction, a new focus for that money, one that would be safer, one that would produce what you really are looking for in retirement once you lose the security of that paycheck, and that's income. So what's the last consideration for 2025? Well, this one is a big one. Now, granted, I have to say that we did get the passage of the big, beautiful bill. And whether you believe it's beautiful or not, we can certainly all agree on one thing. It's definitely big. And there's lots to it, as there always is. But we are responsible for the direction of our money. We are responsible for how much tax our money gleans us. And one of the things that I really encourage you to study and to look at and to explore with your money, aside from doing things like Roth conversions, is tax deferral. You would be amazed at the number of individuals who have found themselves in a position where they're in the next higher tax bracket simply because no one has ever taught them about tax-free and tax deferral. And folks, it's one of the simplest things that I can imagine as an advisor. Imagine this, and maybe you've already had this experience where you had mutual funds in a post-tax account. The balance of the account was down for the year. And then the very next, month or 2 or 3, you get a 1099 after the end of the year that says, oh, congratulations, you got to pay taxes on capital gains. And you're baffled. You're absolutely befuddled because you're in a position where the account is down. How could you be on the hook for capital gains and capital gains tax when your account is down? Well, the reality, my friends, is that it's because you're not in control. When you own things like mutual funds, it is the fund manager that is responsible for determining what to keep and what to liquidate within that fund. And if he or she chooses to sell something and they sold that something at a gain, guess who's going to be paying a capital gains tax, even if the overall balance of your account is down? This is the harsh realities. And all too often, I've seen people throwing themselves into the higher tax bracket simply because their advisor, or even themselves if they're a do-it-yourselfer, they've never understood that they could start to divert money towards things that are tax-free and things that are tax-deferred. Now, does that necessarily mean putting your money into things like IRAs? Well, it could. That's tax-deferred. But we do realize that you can only defer that for so long until you're 73. No. What we're talking about is things that are tax-deferred that come from insurance companies. Things like fixed interest annuities, indexed annuities, the list goes on. These are things that we can deposit money in. We can make certain our principal is safe if we're using a fixed type of an annuity. But guess what? We can defer the gain or the taxes on the gains literally until we die. We can pass it on to the next generation if we wish to. And all too often, it's underutilized by financial advisors. It's something that, well, they would rather sell a product, make a commission. They'd rather sell you a mutual fund or something that had a renewal 12B1 fee in it. These are things that happen all of the time. So as a true rounded financial advisor, remember, it's not just about taxes or gains or income. It's about all of it. As a client, you deserve someone who is focusing on all areas of your financial life. I'm Matthew Johnson. Thank you so much for listening and watching. And remember, it's up to you to make today a great day.